We're witnessing an unprecedented economic collision that most Americans don't even know is happening yet. While you were focused on your daily routine, the foundations of global trade just cracked wide open, and the shockwaves are about to hit your wallet, your savings, and possibly your entire financial future. Trump's move on Greenland wasn't just diplomatic theater. It was the opening salvo in what's rapidly becoming the most dangerous trade war of the 21st century, and the European Union just fired back with economic weapons that could reshape everything we thought we knew about international commerce. Right now, at this very moment, gold is doing something it's never done before. We're not talking about a modest uptick or a temporary flight to safety. We're talking about record-shattering prices that have veteran traders and institutional investors scrambling to reposition entire portfolios. The question isn't whether you've heard about this, the question is whether you understand what it means, and more importantly, whether you're prepared for what comes next. Here's what we're going to unpack together over the next 30 minutes. First, we're going to trace the exact chain of events that turned Greenland from a remote Arctic territory into the epicenter of a global economic crisis. You need to understand the strategic calculus here because this isn't about ice sheets or real estate. This is about resources, shipping lanes, and geopolitical dominance that will define the next 50 years. Second, we're going to examine the European Union's retaliation in granular detail, because their response reveals just how seriously they're taking this threat and how far they're willing to go to protect their economic interests. Third, we'll connect the dots between these escalating tariffs and what's happening in global financial markets right now, including why major currencies are experiencing volatility we haven't seen since the 2008 financial crisis. Fourth, we're going to decode gold's historic surge, not with vague generalities, but with specific analysis of what institutional money is doing and why. And finally, we're going to get intensely practical about what you can actually do to protect yourself, your family, and your financial future in an environment where the old rules no longer apply. Let me set the stage with something that didn't make the mainstream headlines. 3 weeks before Trump's public announcement about acquiring Greenland, a series of closed-door meetings took place between U.S. defense officials, energy sector executives, and geopolitical strategists. The topic wasn't ice. It wasn't climate research stations. It was rare earth minerals, the same materials that power everything from smartphones to military defense systems. And China currently controls about 70% of global supply. Greenland sits on deposits estimated to be worth trillions, plural with a T, and those deposits represent the potential to break China's stranglehold on technologies essential to modern civilization. But here's where it gets complicated, and this is the part most analysis misses. Greenland isn't an independent nation making its own decisions in a vacuum. It's an autonomous territory of Denmark, which means it's functionally part of the European Union's economic sphere, even though it's not an official EU member. When Trump started floating acquisition proposals, first diplomatically, then with increasing economic pressure, he wasn't just negotiating with a small Arctic population. He was directly challenging Europe's sphere of influence, and more specifically, threatening to pull a resource-rich territory that European nations have long-term strategic plans around. The initial response from European capitals was dismissive, almost mocking. German officials called it absurd 19th century thinking. French diplomats labeled it neo-colonial fantasy. Danish leadership issued polite but firm rejections. And that's when Trump escalated to tariffs. Not subtle, carefully calibrated trade adjustments, aggressive, comprehensive tariffs targeting European exports across multiple sectors simultaneously. Automobiles, pharmaceuticals, luxury goods, agricultural products. The stated justification was trade imbalance correction and national security, but the underlying message was crystal clear. If you won't negotiate on Greenland, we'll negotiate with economic pressure. Now, pause for a moment and consider the historical parallels because they're chilling. Every major trade war in modern history started with confident actors assuming the other side would blink first. The Smoot-Hawley Tariff Act of 1930 was supposed to protect American industry. Instead, it triggered retaliatory tariffs from dozens of countries and deepened the Great Depression. Fast forward to today, and we're watching a similar pattern unfold, except this time, the weapons are more sophisticated and the economic interdependencies run deeper than anything that existed in 1930. The European Union's response came faster than most analysts predicted. Within 48 hours of Trump's tariff announcement, the EU activated emergency trade protocols and announced their own comprehensive tariff package. But here's what makes this different from previous trade skirmishes. The EU didn't just mirror American tariffs. They strategically targeted products and sectors that would inflict maximum political pain in key swing states and congressional districts. Wisconsin cheese, Kentucky bourbon, Florida citrus, Iowa soybeans. These aren't random selections. These are precision strikes designed to create domestic political pressure on the Trump administration by hurting the exact constituencies that form his political base. Think about the game theory here for a second. Both sides are now locked in a dynamic where backing down signals weakness, but escalating further risks catastrophic economic damage. It's the classic prisoner's dilemma playing out on a global stage with trillions of dollars at stake. And unlike previous trade disputes that happened in relative isolation, this one is unfolding while global supply chains are still fragile from pandemic disruptions, while inflation remains elevated, and while geopolitical tensions with China and Russia create additional complexity that makes every decision more dangerous. Let's talk about what's happening on the ground right now, in real time, in actual businesses and actual markets. European automotive manufacturers who export to the United States are facing tariffs that make their vehicles substantially more expensive than American-made alternatives. That's not a theoretical problem. That's BMW, Mercedes, Volkswagen, Audi looking at market share erosion and production shutdowns. American agricultural exporters who rely on European markets are watching contracts get canceled and prices collapse. That's not abstract economic theory. That's family farms in the Midwest staring at bankruptcy because the soybeans they planted expecting European buyers now have nowhere to go at profitable prices. The cascade effects multiply exponentially. When European car manufacturers face reduced American demand, they cut orders from parts suppliers. When those suppliers reduce production, they lay off workers. When those workers have less income, they reduce consumption. When consumption falls, other businesses suffer. And the same pattern repeats on the American side when retaliatory tariffs hit. This is how trade wars transform from policy decisions into full-scale recessions. Now let's connect this to what's happening in currency markets, because this is where the story gets truly alarming. The dollar and the euro are both experiencing unusual volatility, but not in the direction you might expect. In a typical US-EU trade conflict, you might anticipate one currency strengthening as the other weakens based on perceived economic advantage. That's not what's happening. Both currencies are showing weakness against alternative stores of value, and that simultaneous decline tells us something profound about what real investors actually think about this situation. When professional money managers, the people controlling pension funds, sovereign wealth funds, endowments, insurance company reserves, start moving away from both major Western currencies simultaneously, they're sending a signal that the problem isn't which side wins the trade war. The signal is that the trade war itself represents systemic risk to the entire framework of Western economic stability. These aren't emotional retail investors panicking over headlines. These are sophisticated institutions with PhD economists running quantitative models, and their models are telling them to reduce exposure to both dollars and euros. Which brings us directly to gold, and this is where we need to cut through decades of confusion and mythology to understand what's actually happening. Gold isn't rising because of some mystical property or because of gold bug enthusiasm. Gold is rising because it's one of the few assets that exists outside the system of government-issued currencies and international trade agreements. When that system itself comes under question, gold becomes the default alternative, not because it's perfect, but because it's apolitical. Look at the specific price action over the past 60 days. Gold started this period around $2,100 per ounce, a level it had been consolidating around for months. When the first whispers of Trump's serious interest in Greenland started circulating in geopolitical intelligence circles, gold ticked up modestly. When the tariff announcements became official, gold jumped through resistance levels that technical analysis thought would hold for months. We're now looking at prices that have shattered every previous record, and more importantly, the buying isn't stopping.
Here's what separates this gold surge from previous ones. In past safe haven rallies, you typically see intense buying followed by profit taking as traders cashed out gains. The current pattern shows sustained accumulation with very little selling pressure. That's not speculative trading. That's professional money flowing into gold with conviction we haven't seen in decades, and there's no sign it's stopping. But let's zoom out even further because the gold story is actually a chapter in a much larger narrative about what happens when the architecture of global cooperation starts to crack. The post-World War II economic order was built on certain assumptions that major Western powers would resolve disputes through negotiation rather than economic warfare, that trade would generally become freer over time rather than more restricted, that international institutions could manage conflicts before they spiraled out of control. Those assumptions are being tested in real time right now, and financial markets are pricing in the possibility that they might not hold. Consider what the World Trade Organization was supposed to do in exactly this type of situation.
Theoretically, both the US and EU should be bringing their grievances to WTO dispute resolution mechanisms, presenting evidence, allowing neutral arbitration. That's not happening. The Trump administration has systematically weakened the WTO by blocking appointments to its appellate body, rendering it effectively non-functional. The EU has explored alternative arbitration, but without U.S. cooperation, those mechanisms have no teeth. What we're witnessing is the breakdown of the institutional framework that was designed to prevent exactly this kind of escalating trade conflict. And here's the terrifying part that keeps economists awake at night. Once you abandon institutional dispute resolution in favor of unilateral economic action, there's no clear de-escalation pathway. How does this end? Does one side capitulate entirely, accepting humiliation and economic damage? Does some face-saving compromise emerge? And if so, what could that possibly look like when the underlying dispute is about fundamental spheres of influence? Or does this simply continue escalating until the economic damage becomes so severe that both sides are forced to negotiate from positions of mutual weakness rather than strength? Let's talk about the specific sectors being devastated right now, because this isn't evenly distributed pain. European luxury goods manufacturers are experiencing order cancellations that represent years of lost revenue. American agricultural exporters are watching prices collapse in real time as European buyers source from South American and Australian alternatives. Technology companies with integrated supply chains spanning both continents are facing regulatory compliance costs and tariff expenses that make entire product lines unprofitable. Financial services firms are grappling with currency volatility that makes international transactions and hedging strategies exponentially more complex and expensive. The pharmaceutical sector deserves special attention because the implications go beyond economics into public health. A significant portion of medications consumed in the United States are manufactured in European facilities or use European-sourced ingredients. Tariffs on pharmaceutical imports don't just raise prices, they create supply chain vulnerabilities for life-saving medications. Similarly, many European nations rely on American-developed drugs and medical technologies. When trade wars hit healthcare, the human cost can't be measured purely in dollars and cents. Now let's address the question everyone's actually thinking, but most analysis avoids. How bad could this realistically get? The optimistic scenario is that political pressure from affected industries forces both sides to negotiate before permanent damage occurs. Companies threaten to relocate, workers threaten electoral consequences, stock market declines create urgency, and cooler heads prevail. That's possible. It's happened before in various trade disputes. The pessimistic scenario is darker and frankly more consistent with historical patterns of great power conflict. In this version, nationalist political pressures make compromise politically impossible for leadership on both sides. Tariffs remain in place for months, then years. Supply chains permanently reconfigure away from transatlantic integration. The US and EU economic blocs gradually decouple, each building their own separate spheres of influence. Global economic growth slows substantially as efficiency gains from specialization and trade are replaced by expensive redundancy and protectionism.
And in this environment, gold doesn't just surge temporarily, it becomes permanently repriced higher as a structural feature of a more fragmented, less cooperative world. There's also a middle scenario that combines elements of both. Perhaps the Greenland dispute itself gets quietly shelved as attention shifts to other crises. Perhaps tariffs are partially rolled back, but some remain as new baseline trade friction. Perhaps the US and EU patch things up superficially, while privately both sides accelerate efforts to reduce economic interdependence. This muddle-through scenario might avoid catastrophic headlines while still representing a fundamental shift in how the Western economic order operates. What makes prediction especially difficult is the sheer number of variables in play. This isn't happening in isolation. We're also watching China's economic slowdown, potential escalation in Eastern Europe, climate-related disruptions to agriculture and infrastructure, artificial intelligence transforming labor markets, and demographic shifts in major economies. Any one of these factors could interact with the US-EU trade tensions in ways that accelerate or mitigate outcomes. The complexity is genuinely unprecedented. So, what do you actually do with this information? How do you translate geopolitical analysis into practical personal financial decisions? Let's get specific, because vague anxiety without actionable strategy is worthless. First, understand your exposure. If your job, your business, or your investments are heavily concentrated in sectors directly impacted by these tariffs, you're holding more risk than someone with diversified exposure. That doesn't necessarily mean panic and immediate changes, but it does mean elevated awareness and possibly hedging strategies. If you work in automotive manufacturing, agricultural exports, luxury goods, or complex international supply chains, your employment risk has increased materially. That might warrant building larger emergency cash reserves or updating your resume and professional network even if you're not actively job searching. Second, reconsider your currency exposure. If all your assets are denominated in either dollars or euros, you're making an implicit bet that this trade war resolves favorably. Diversification might mean holding assets in other currencies, though each comes with their own risks. Swiss francs have historically served as a safe haven, but carry interest rate costs. Japanese yen positions benefit from Japan's safe haven status, but expose you to their demographic and debt challenges. Emerging market currencies might offer opportunities but add volatility. There's no perfect answer, which is why diversification itself becomes the strategy. Third, the gold question. Is this the right time to buy gold at all-time highs? The honest answer is it depends on your timeline and conviction. If you believe we're in the early stages of a multi-year repricing of Western currencies and trade relationships, then current prices might look cheap in retrospect. If you think this is a temporary panic that will resolve in months, you might be buying the top. The most defensible approach for most people isn't all or nothing. It's incorporating gold or gold-backed instruments as a measured percentage of overall portfolio, perhaps 5 to 15% depending on risk tolerance, as insurance rather than speculation. Fourth, consider debt exposure carefully. In an environment of currency instability and potential economic slowdown, carrying variable rate debt or large fixed debt in a weakening currency creates risk. Conversely, if you expect inflation to accelerate as trade wars create shortages, fixed rate debt in a depreciating currency might actually benefit you. The key is making conscious decisions about debt, rather than just carrying it passively without considering how these macro dynamics affect your personal balance sheet. Fifth, maintain liquidity. In volatile, uncertain environments, having access to cash or cash equivalents provides options and reduces forced selling at unfavorable times. This seems obvious, but it's remarkable how many people and businesses operate with minimal liquidity buffers during calm times and then face crisis when volatility hits. Build cushions now while you can, even if it means accepting lower returns on that portion of assets. Sixth, stay informed but don't become paralyzed. There's a difference between monitoring developments so you can adapt your strategy and obsessively consuming news until anxiety prevents clear thinking. Set aside specific times to review economic news and analysis, make thoughtful adjustments to your financial positioning as warranted, and then live your life. The goal isn't to perfectly predict unpredictable events. It's to remain resilient across a range of possible outcomes. Let me give you a framework for thinking about this that cuts through the noise. In any complex crisis, there are things you can control, things you could influence, and things you can only prepare for. You cannot control whether Trump and EU leaders escalate or de-escalate this trade war. You cannot control where gold prices go tomorrow or next month, and you cannot control whether your specific industry gets caught in crossfire. But you can control your own financial positioning, your debt levels, your diversification, your emergency reserves. You can influence your career trajectory by developing skills and networks that remain valuable across different economic scenarios, and you can prepare for various possibilities rather than betting everything on one outcome. The professional investors and institutional managers who are successfully navigating this environment aren't doing so because they have crystal balls. They're doing so because they build robust portfolios designed to survive and potentially thrive across multiple scenarios. They think in terms of probability-weighted outcomes rather than single-point predictions. They maintain discipline when emotions run high, and they adapt as new information changes the landscape. Here's something else worth considering that doesn't get discussed enough. Crisis creates opportunity alongside danger. The Chinese word for crisis famously combines the characters for danger and opportunity. And while that's somewhat oversimplified linguistics, the principle holds. When major structural shifts occur in global economics, assets get mispriced, new businesses become viable, and prepared individuals and organizations can position themselves advantageously. This isn't about celebrating economic hardship. It's about recognizing change, even difficult change, redistributes winners and losers rather than making everyone lose equally. What might those opportunities look like? Companies and investors who can facilitate trade outside the US-EU corridor might find new demand. Businesses that can reshore production or reconfigure supply chains quickly might capture market share.
Slower competitors, financial institutions that can navigate currency volatility and help clients hedge exposure, might grow substantially. Countries and regions that position themselves as neutral trading partners might experience investment inflows. None of this is guaranteed, but awareness of possibility is the first step toward capitalizing on it. We're now entering the final phase of this analysis, and I want to bring together all these threads into a coherent picture of what this means and where we likely go from here. The Trump Greenland tariff situation, triggering a US-EU trade war while gold hits records, isn't just a headline. It's a symptom of deeper structural tensions in how global power is distributed and how economic cooperation happens. For 70 decades, the Western economic order operated on the assumption that free trade benefits everyone and that disputes could be managed within institutional frameworks. That consensus is breaking down, not because of one leader or one policy, but because underlying geopolitical and economic realities have shifted. China's rise has created genuine strategic competition that didn't exist when the post-war system was designed. Climate change and resource scarcity are introducing zero-sum dynamics into areas that used to feel abundant. Technological change is disrupting labor markets faster than societies can adapt. Wealth inequality within nations is creating political populism that rejects international cooperation. These are the deep currents driving surface events like tariffs and trade wars. Gold's surge is the financial market's way of expressing uncertainty about whether the existing system can adapt to these new realities, or whether we're transitioning into something fundamentally different. And uncertainty, as any options trader will tell you, has value. When the future becomes more uncertain, insurance becomes more valuable. Gold is insurance against the possibility that currencies and government promises might not hold value the way they have for decades. So, where does this go? In the immediate term, expect continued volatility. Both the US and EU have domestic political calendars and pressures that will influence decision-making, and those pressures don't necessarily align with rational economic optimization. Markets will oscillate based on headlines, negotiations, and periodic hopes for resolution. Gold will likely remain elevated with periodic pullbacks as traders take profits, but the underlying bid should persist as long as fundamental uncertainty remains. In the medium term, watch for how businesses actually respond.
If major corporations start announcing permanent supply chain reconfigurations, facility relocations, or strategic pivots away from transatlantic integration, that's a signal they believe this is structural rather than temporary. Corporate actions speak louder than government rhetoric because companies vote with capital expenditures and long-term commitments. In the longer term, we might be witnessing the early stages of a genuine shift from a unipolar Western economic order toward a multipolar world with competing economic spheres. That doesn't necessarily mean conflict and decline. Multipolarity was the historical norm for most of human history. But it does mean different rules, different opportunities, and different risks than what we've experienced for the past several decades. The Greenland crisis, the trade war, the gold surge. These are chapters in an ongoing story about how power and prosperity get redistributed in a changing world. Your job isn't to write that story. It's to make sure you and your family remain capable of thriving regardless of how it unfolds. Stay sharp, stay diversified, stay resilient. That's how you win in uncertain times. If this analysis helped you understand what's really happening behind the headlines and gave you practical frameworks for protecting yourself, share this with someone who needs to hear it. Drop a comment below telling me what aspect of the situation concerns you most or what questions you still have. And subscribe if you want to continue cutting through the noise to understand the economic forces actually shaping your future. The story isn't over. In many ways, it's just beginning. Make sure you're ready for what comes next.